So IFRS 18, which is our new standard, represents the most significant change to the presentation of financial statements since IFRS accounting standards were introduced over 20 years ago. Let me just briefly outline the three main components to the changes that we're making. First of all, we'll bring more consistency and more comparability to the structure of the P&L statement by introducing two newly defined subtotals, one for operating profit and one for profit before financing and income taxes. The second area is that we'll bring more transparency to the use of what we sometimes call as non-IFRS or non-GAAP metrics that companies often use to tell their own story. Investors value those metrics, but they tell us sometimes they lack transparency. And the third area is to look about how companies group information. What do they disclose on the face of the P&L and what is disclosed in the notes to the financial statements? So the requirements will become effective from the 1st of January 2027. Companies do have the option to early adopt the standards if they choose to do so. In the intervening period, we'll be providing support to companies through education and implementation support to ensure that IFRS 18 has a smooth arrival in the market. Well, our mission is to bring transparency, accountability, and efficiency to financial markets. That's what we do. Companies that choose to join capital markets have rights and responsibilities, and one of those is to provide transparency to investors around their financial statements. So there are a very few exceptions in IFRS accounting standards where companies can consider applying an exemption for commercial sensitivity or confidentiality, if you like it, but those are really exceptions. So transparency is important to us to ensure that capital markets operate in an efficient and effective manner, and resources ultimately are allocated to those investments that are going to deliver the highest return. So I mentioned a moment ago that we were going to define, or we will be defining, operating profit under IFRS 18, and operating profit is one of the most commonly used subtotals in the income statement. But up until now, companies and sometimes countries have devised their own definition of operating profit. So we looked at a sample of 100 global companies, and we found 60 of those had an operating profit type metric. And within that 60, there were at least 9 different definitions of how that number had been worked up. So there was no comparability, even though the metric had the same label. So under IFRS 18, as I say, operating profit will be defined. Companies can choose to perhaps present outside the financial statements an adjusted operating profit number, but if they do, they'll have to provide that transparency of a reconciliation back to the IFRS number. Now, you mentioned seeking common ground. I think that's important as we recognize that investors around the world, including in China, have become more global in their outlook, and they're comparing potential companies to invest in within sectors, between different markets, and actually to have comparable performance metrics in the income statement will be a real achievement and a real win for the investment community. So we have some specific requirements which IFRS 18 introduces around how information is grouped. And what we heard from the market, from investors, is that sometimes information is grouped at too high a level, and sometimes information is grouped at too low a level. So actually, it obscures what really matters to investors. So we'll provide guidance to companies to help them think about grouping information. What's the appropriate level? We'll also provide some guidance in terms of what should be on the face of the P&L statement and what should be in the notes. And we would talk about what should be actually on the face of the P&L statement in terms of providing a useful, structured summary of a company's assets, liabilities, equities, income, and expenses. And then the notes provide supplementary data to that. So we'll help provide that guidance. A third area where grouping comes into play is the use of the word other. Often we find companies use that label around perhaps income or expenses, and we're asking them to try and avoid using that label, but if they really have to use that label, provide investors with more information about what's being included in that other category. So before I joined the International Accounting Standards Board, my job was as an investor, and I would often look at new companies. And every time I came to look at a new company, I had to solve the puzzle of how does the P&L statement work for that particular company. And as I mentioned earlier, companies have had a lot of choice in terms of how they structured their P&L. They have to have a revenue line, and then they have to have a profit and loss line. And between the two, it's been quite freeform up until now. So we will introduce 3 categories: one for operating, one for investing, and one for financing. And those categories will be delineated by the new subtotals. So one subtotal for operating profit and the second for profit before financing and income taxes. So we have a structure. So every time now I come to a company, I know how their income statement works. I don't have to spend the first hour of my time working out what fits in where. And that's also important for digital reporting. I'm sure you appreciate digital is becoming a much more important part of all of our lives, including in financial markets. So with digital, often I just get a list of data items. I now have a mental map of how those will fit together for every company because it's the same map. So we recognize that that focus on consistency and comparability is important for investors, and that's what we're bringing with that more structured approach to the income statement. So it is all about providing tools for investors to provide them a solution to some of the problems that we've already discussed. And there are some specific circumstances where we may need to look at companies in terms of whether we need to make adjustments to those categories. So I say we ensure we have those categories. Those categories align with how investors think about their analysis of companies. But we'll come across companies where they may have activities, particularly if they provide financing themselves to companies or they invest in assets themselves, where we may have to say that their main business activities, actually to ensure that they are represented in operating, we may need to move something up from financing or investing. So a good example would be a bank. What's very important to a bank is that they can show their net interest income within operating profit. That's at the heart of their operations. So under those specific circumstances, a bank will have to move up interest income and interest expense into the operating section. And that makes more sense for their business model. So inherent in our requirements is to ensure that operating captures all of a company's main business activities. So there is it flexes for those companies, let's say, that provide financing or invest in assets. So I think the overall message is that actually where we end up now with the structure that we have is that it really aligns with how investors go about their work. So they will focus on the operations first of all. That's their key piece of analysis. Then they'll look at what other investments a company may have that are, let's say, auxiliary to their main business activities. And then they'll want to deduct their financing, their liabilities, which are in the financing section, to come up with a valuation of the business. We're not in the role of valuing companies. Our role is to help investors by providing them with information for them to do their job. That there is, again, a particular area, and I think it's relevant particularly to some jurisdictions, some countries, including China, and some industries, around associates and joint ventures. So they're often a significant part of some companies' business, and some companies consider those to be part of their day-to-day operations. But we had a very strong message from investors that they don't want to see the income from equity accounted associates and joint ventures in operating profit because there's no revenue from those investments in the revenue line. So immediately, if you include it, you get a distortion to your margin, to your operating profit to revenue ratio. So investors have asked that there always outside of operating profit. But we realise and appreciate some companies think they are an important part of their business. And so under circumstances where it helps provide a useful structured summary, companies can provide a subtotal, an additional subtotal of operating profit plus income and expenses from those joint ventures and associates accounted using the equity method. So it does seek to accommodate some of those nuances as well. So I think that there is guidance, particularly around what we talked about, how information is grouped earlier, and to ensure that there is more transparency, particularly around what we could describe as non-GAAP or non-IFRS measures. But we're also, if we step back and think in terms of the big picture, financial reports, general purpose financial reports, do not and cannot provide all of the information that an investor needs to make an investment decision. Investors will look, I know from my own experience, will look to many other sources of information alongside the financial statements. Now, financial statements provide them with a foundation. You know, most investors like to model what the numbers are going to look like in the future, and you need a framework to do that, and that's what the financial statements provide you with. Equally, there will be an ongoing requirement within the new standard to think if there is material information that's important to investors and them making their decisions, which we haven't asked for specifically, companies are obliged also to include that as additional information in their financial statements. So they need to think about if there's something really important to investors in their thinking, there's an obligation on companies to disclose or provide that information. So the standard will affect all IFRS, all companies reporting under IFRS, but to different degrees. It depends where they're starting from at the moment. So some companies will have to make one-off changes to their systems to capture new information that the standard may require. We don't see a significant increase in ongoing costs for companies. And throughout the process, throughout this project, we work very closely with our key stakeholders, including companies and investors, to ensure that we get an appropriate balance of costs and benefits. We're always weighing up that equation. And we believe, on basis of the feedback, as I say, we've had from companies in terms about any additional costs that they will face, and from investors, that equation stacks up, that the benefits are significantly higher than the costs. A lot of this is repurposing existing information. So if we think about the shape of the P&L, having those defined subtotals, it doesn't change the bottom line for the P&L. It doesn't change the profit line. It simply changes how you arrange the numbers on the page to bring more consistency and comparability. There will be some other areas where there are some additional ongoing costs, but we think they'll be relatively modest.